So if you are someone who is doing systematic investment plan for your long-term investment journey, you may be losing 10, 20 or even 30 lakh rupees without knowing it yourself. And this investment mistakes or systematic investment plan mistakes are pretty common when you're not aware of it. Systematic investment plans are monthly recurring investment decisions which are automated for you. So you don't have to think much about it, but the investments are made for you in an investment vehicle, such as mutual funds. And a pretty common mistake I see that people do in this kind of investments is investing in regular plans rather than direct plans. So let me briefly cover it, what actually happens. So if you go into a bank, from the door to the banking counter, the space in middle is always filled with agents. And this agent usually sells you insurance, health insurance, life insurance, as well as some investment vehicles. When you listen to them and buy into some investment vehicle such as mutual fund, what you're doing is you are investing in a regular plan. This regular plans comes with agent commission included in the fee structure. And opposite to regular plans are direct plans. Direct plans are what you go and directly buy it from the mutual funds. But regular plans you go via an agent, and usually this agent charges some commission fee from you. At first it doesn't look that big, but when you do a calculation of 10,000 SIP for let's say 20-30 years at 12% interest rate, it almost comes to be like 10-20 lakh rupees for just the fees you're paying for a agent. The second mistake is included with the first mistake. Sometimes these agents also sell you investments and insurance plans. At first it's look very attractive. The lock-in period, the complex structure, the payouts. They structure these investments, combination of investment, to make it attractive for the person who is buying it. But actually if you do the maths, most of the times it doesn't work in your favor in the long term. You're always playing a losing game in this. So never play the both games, insurance and investments, in a single plan. Always separate those. The third is also related to these agents. A lot of these agents comes and sells you NFOs, new fund offering. And my view to new fund offerings are never go with it unless they have built a history of 4 or 5 years. Because if you go in a newer fund, you don't know who is the fund manager, why they are starting and what's their goal. Just because it sounds like an IPO, it is not. These NFOs are just in the beginning phases. Maybe they are in the traction of gathering money. You don't know what is happening with them. But a lot of these agents sell you this dream similar to IPO, but it is not. NFOs are just a vehicle to grab attention at the initial stages. And you don't know how much return you will be generating after that. So always avoid NFOs sold by these agents. These are also aggressively sold by the parent company itself. So always try to avoid those. Go with older plans who has an history of 4, 5 or 10 years. The fourth mistake is do not try to complicate which fund I should invest. Should I go with mutual fund of low cap, mid cap, or high cap, and you try to play a lot of combinations of it. Let you tell me one thing. These mutual funds can outperform the Nifty index by 1 year. By 5 years, 50% of them would not be able to outperform them. And by the time you go to the 10th year, 60 to 70% of these mutual funds are never able to outperform the basic index, Nifty 50 index, for 10 years. And if you go beyond 10 years, 15, 20 years, these mutual funds will not be able or will be very close to the whatever the Nifty index is giving. So if you're confused in which of the mutual fund I should select, the most of the simplest option would be an ETF, because the fee structure is also low in this kind of investments, and you would be able to capture the 80% or 90% of the growth in overall Indian economy. The fifth mistake is not having an emergency fund. A lot of times what I see is people jump into investment vehicles because they want to start investing. But before you start investing, you have to create a safe haven or safety fund called as emergency fund before you jump into volatile markets. Because these markets can give you negative 10% return a year, and next year maybe it gives 20-30%. You cannot guarantee return of 10-12% every year. These are fluctuating returns. So you have to keep an emergency fund for any kind of mishap or uncertain situation that happens in your life. So if you don't create this emergency fund, Whenever there is an emergency and need for immediate money, you will be taking out the money, which may be profitable, may not be profitable, depending upon the market situation. So never invest just for investing. Try to build a fund of safety first, and then move forward with your daily SIPs. The sixth common mistake I see is a shrinking SIP or a stagnant SIP over the period of 5-10 years. A person starts SIP of 5,000 in his initial days, and then for 5-10 years he keeps his base amount similar. But here the person is missing a lot of compounding of base amount. The SIP that you're investing is basically shrinking over time with inflation. So the best method to utilize your growth in your career, plus how to generate more compounded returns, is increase this 5,000 from whatever your career grows into. Initially you started investing 5,000, maybe next year you have some increase in your salary, 5 becomes 6, 6 becomes 7. So like that you should increase your amount of SIP. Like this you will be able to generate a lot of additional compounding returns by the time your investment matures. See you later.